Hey everybody, Smart Silver Stacker here. Hope you're doing well. So, we've seen a pretty significant drop in the price of silver today. Just take a look at the chart here before we get started, just to give you an idea of the magnitude of this decline. Here, courtesy of ST Bullion, you can see we're down a little over 60 cents. On the one-day chart, you can see that was a big drop. And I want to talk about what has precipitated this decline in the price of silver and also of gold, both of the metals down today on this development. And I want to get into why I believe markets this time around are really getting this one wrong. And we'll just get right into it today. So, the news that has caused this decline in the price of silver is the US GDP numbers that were released. So here's a headline from Bloomberg. US economy powers ahead, boosting chances of averting recession. So we had the US GDP numbers come out for the second quarter year over year. It's up 2.4%. That was against expectations of 2%. And so what's going on here is investors are interpreting this strong economic data, quote unquote, strong economic data in the form of these US GDP numbers as meaning that the Fed is going to have the go ahead to become more hawkish throughout the rest of the year and moving forward in terms of primarily their rate hike campaign. And I just don't know that investors are getting this one right. I'll go ahead and get into why I think that this data is not indicative of a strong U.S. recovery, but just a harbinger of further decline. We're going to get into all those numbers. First of all, if you do want to take advantage of the decline that we are seeing in the price of gold and silver today, make sure you check out stbullion.com, today's video sponsor. Right now, new customers can get gold or silver at spot by visiting stbullion.com/new. And they also have some pretty good sales going on right now. They still have those Britannias for $279 over spot any quantity. Now, going back to this article from Bloomberg, one of the things that they quote as being responsible for the increase in GDP here is consumer spending. So, in the going to the article here, they say consumer spending, the engine of the U.S. economy, increased at a 1.6% pace after surging at the start of the year. The latest print was more than forecast and reflected solid outlays on both goods and services. Okay, so part of the reason that investors see this GDP number go up and they think, well, everything's good is because consumers are spending more. That's part of what is driving this increase in GDP. But I don't think that this is necessarily a sign that the US consumer is strong. I think that it's an indication that they're getting desperate, especially when you look at it in light of this chart from the Federal Reserve. This is consumer loans, credit cards, and other revolving plans, all commercial banks. And you can see that consumer debt is now surpassing record highs, close to $1 trillion in credit card debt. I think the average rate of interest these days on a credit card is somewhere north of 20%. It's like 21%, the average rate. So you got to figure some of these people are paying more than that in interest on these balances. And, it's only a matter of time before the US consumers begin getting completely tapped out and they begin defaulting on this consumer debt because, unlike the federal government, who can simply have their debt monetized and purchased by the Federal Reserve, there is no lender of last resort for the US consumer. So this is representative of a huge bubble. And as interest rates continue to rise, the Fed just hiked rates again by another quarter point. This bubble is going to continue to grow until it pops. And then when it does, that is not going to be a time when the Fed will be looking at tightening rates. It's one where they will be forced to intervene. Just as with, the massive levels of debt at the national level, it pervades the whole system. And so, a lot of this GDP number is driven by consumer borrowing. And another thing I want to say about this is an inflation adjusted GDP number. Okay, so they use methodology similar to how they calculate the CPI. And, these numbers, they vastly understate inflation. And so if you're adjusting your GDP for inflation to get a real growth number, but then you are, understating inflation in that adjustment, that will make your GDP look larger than it really is, because a lot of that GDP growth is actually being driven by underreported inflation, if that makes sense. And if you are tuning into today's video, looks like we got about 98 of you. Just do want to say a big thank you to all of you. Make sure you please smash that like button if you find this information to be helpful. Determining why the silver price is falling today, kind of putting that into some context for all of you. And if there's anything you'd like me to comment on, please do put it in the chat. Always appreciate interacting with all of you. Let's see, here we go. Zero H says, how the hell can they print money, raise the rates? People lose jobs and they see GDP going up and say, well, everything is good. Yeah, exactly. Well, it's all about managing perceptions. Powell actually kind of commented on that at the recent FOMC press conference. He mentioned that he wanted to try to reduce the inflation expectations, and that hopefully that would help bring down actual inflation. It's not the massive deficits in Washington and the years of Fed debt monetization that are continuing to make inflation a persistent problem. No, it's people's inflation expectations. Speaking of inflation, this is kind of an aside, but I thought this was pretty interesting. They talk about how inflation is coming down now. We've got headline CPI, the last number I think was 3%. And everybody thinks, oh, inflation's coming back down. This is great. I just was playing around with the inflation calculator today. And very interesting, if you just put in the year 2020 to today, and you put the number in as $100,000, and I think that the impact of inflation, when you start putting these larger sums into a calculator, somehow makes it a little more real. But just between 2020 and today, if you had $100,000 back then, you would need $117,000 today to have the equivalent purchasing power. And that's pretty wild, right? Because, the Fed, sometimes they talk about inflation averaging. They talk about that a lot when they were trying to get inflation to move higher. They don't talk about it so much now that they are in the business of trying to reduce inflation. But, they say their target rate is 2%. In order to get to an average 2% over the past couple of years, we would need a serious period of deflation because of how high inflation has become. So that's kind of an aside, but just an interesting way to kind of think about the devaluation of our currency. And again, this inflation calculator based on the CPI, which understates the real loss of purchasing power through mechanisms such as hedonics and adjustments. The whole methodology of calculating the CPI is designed to understate inflation, and that's why it's not the same methodology that was used back in the 1980s and the 1970s. Here's another reason why the Fed is not likely to be hiking rates for much longer, if you ask me. If you ask me why, I don't think that just because we got a positive GDP number that the U.S. economy is out of the woods. And that is this story. I haven't seen too much commentary on this in the mainstream, certainly some on YouTube, but Bank of California has announced that they are buying PacWest Bancorp, which came close to failing earlier this year. This is from the AP. And some very interesting stuff about PacWest Bancorp and the ongoing bank crisis. So this is not a bank failure, it's true, it's a consolidation. But part of what was going on here was PacWest Bancorp, they had kind of this business model where they would have a lot of wealthy investors, a lot of uninsured deposits there. People were getting concerned about their liquidity. They were being forced to sell assets from their troubled bond portfolio, very similar to what happened to SVB, Silicon Valley Bank, earlier this year. And now, very interesting, Bank of California is actually a much smaller bank than PacWest Bancorp. But PacWest Bancorp is going to be rebranding all of their stuff now as Bank of California. So kind of an odd merger, and it's a sign that there is still significant weakness in the U.S. banking sector. And I've certainly been talking about that extensively. I'm not alone in that, but I've been pointing that out that since March, this is not a problem that really has been resolved. It's just one that's sort of been, the can has been kicked down the road. We had the Fed, with their BTFP, Bank Term Funding Program, kind of helping to do a little bit of QE light, if you want to call it that, for these troubled banks. And Fortune, back then in March, was reporting that there was still something like $1.7 trillion worth of unrealized losses on the bond portfolios of these banks. And so I think this is a trend that we're going to continue to see as rates continue to climb. And this regional banking sector of the U.S. economy, it's not going to fail entirely. I have confidence that the Fed will bail them out. But without intervention, I think it's very possible, especially in light of these rising rates, that these banks could continue to show significant weakness. And that is part of why I don't think that just because we're having, a good GDP print, that the metals necessarily should be selling off. But hey, other investors acting irrationally is a huge opportunity for us stackers, if you ask me. That's how I view this. Not financial advice. I'm not telling you to go out and buy silver just because the price dropped, but I'm certainly thinking about it. And, it's interesting. Stackers, I think, are a lot different than other investors in a lot of ways. You see this decline in the price of silver, and it doesn't worry me one bit, holding physical metal. It's not like I care that if I go to the coin shop and I want to sell a coin or a round, I'm going to get a couple bucks less than I might have gotten a few days ago, because I have no plans to sell. But yeah, as a stacker, seeing the price decline, if I can get a discount on some physical metal, if I can buy some of this stuff cheaper, then I am very happy about it. So stackers are an interesting bunch in terms of these movements in the asset that we track. PKI says, what happened today? Well, if you're just tuning in, it was basically a positive GDP print that has convinced investors that there's no more recession, everything's fine, and the Fed can keep hiking rates indefinitely. But I really think that this chart here, this is the balance sheet of the Federal Reserve. This is very telling in terms of what the Fed's going to do when there is a crisis. That's back in March, that little hike up there when they started taking all those troubled bonds as collateral onto their balance sheet from these troubled banks. And we see PacWest Bank consolidating now. It's only a matter of time before we get more trouble in this banking sector. And then we're going to see the Fed increasing the size of their balance sheet again. Powell mentioned at the FOMC press conference that the Fed is continuing to draw down their assets on their balance sheet in their fight against inflation. But I mean, if you look here, we're just now getting to the levels that we were at before the March banking crisis. You can see how quickly this QT can be reversed. And I still am holding to my forecast that we are going to see 10 trillion on this balance sheet before we ever see 8. And I could be wrong about that, but I just have a very strong feeling that we're going to see more intervention, more QE, more Fed monetization of debt in the relatively near future. And I do think that we will hit $10 trillion on the Fed balance sheet before they ever manage to get it down to 8. Because, you hit these points where things start breaking and the Fed basically is forced to intervene. Now, this is another reason why the Fed is going to have to expand that balance sheet. This is something we've talked about in the past, but we have some new data. This is from the Treasury, major foreign holders of Treasury securities. And you can see China there in the number 2 position. This is data from May of 2023. They are continuing the sell-off of U.S. Treasuries down to 846.7 trillion. If you add in the holdings from Hong Kong of 216 trillion, it puts the Chinese holdings over $1 trillion worth of U.S. Treasuries, and they are selling those off at a pretty steady pace right now. But should we see the geopolitical environment devolve any further than we have witnessed, and I mean, clearly that does seem to be the trend we're on. I'm not expecting the whole world to come together and sing Kumbaya just yet. So when the Chinese continue with their debt dump, potentially an accelerated debt dump, the kind that Congress was warning Janet Yellen to prepare for not too long ago, then the Fed is going to be the one who has to come in and intervene there. If you look at the U.S. debt clock, one of the few numbers that is declining on the debt clock is total debt held by foreign countries. That's declining. And yet we are continuing to run massive deficits. The U.S. national debt is climbing. So we've got to find buyers for all of this new debt that we're issuing. And then there need to be buyers coming into the market for the ones that foreign holders like the Chinese are dumping. So who is going to buy all of this debt? Well, there's a few options, right? The interest cost can continue to spike. The yields on treasuries can continue to climb higher to attract new buyers. That is what will happen until something breaks. But the one problem with that is this: the interest on the national debt. I mean, look at that. That is an exponential move up since the Fed began their rate hikes. The US debt is out of control, and there's only so high that the yield on treasuries can go to attract buyers before we reach a terminal point where the interest cost on the national debt begins to exceed all other expenses. When it gets bigger than defense spending, when it gets bigger than Medicare, when it gets bigger than Social Security, well, that's going to become an unsustainable problem. And there's only one possible solution at that point. Well, I suppose we could have massive austerity in the US and the federal government could cut all of its entitlements and all of its spending. Nobody gets Social Security, nobody gets Medicare, nobody gets federal retirement. But I mean, obviously, this is not going to happen. This is politically not viable. And so the easy solution for the politicians is to just have the Fed come in and buy up all the debt. Or who knows? Maybe we'll issue the $1 trillion platinum coin. That's what everybody says every time we get close to the debt ceiling. Oh, they'll just mint a $1 trillion platinum coin and they'll fix everything. Like this little platinum coin right here. If you're holding a platinum eagle, maybe you'll be a trillionaire. No, I mean, because that would be the same outcome, right? It's just debt monetization. The idea that you take a $1 trillion coin and deposit it at the Fed and get money from them, or that you issue, say, like a 50-year treasury with no yield and you just have the Fed buy up $30 trillion worth of those. It's the same thing. This is a headline from Bloomberg. I mean, this isn't completely out of the mainstream here. U.S. racks up $652 billion in interest costs as higher rates bite. Now, I mean, the Fed, if they're going to continue to hike rates, that number is just going to get worse. Also, the fact that we're running massive deficits will contribute to higher interest costs. And what was the highest ever national defense bill that was passed fairly recently over the past couple months? It's like $850 billion. So we're going to be paying more in interest than we pay on defense during a time when we're, funding one of the largest land wars since World War II in Eastern Europe. So interest clearly is getting to be a real problem here. Quick aside, I see someone in the chat there saying, do I like junk silver? Yes, I love junk silver. I don't have any in front of me here to show you, but that was actually my most recent purchase. I picked up a couple of rolls of 90% junk quarters from SD Bullion, and very happy about that. I do like junk silver. Ty McFadden says it's easy to overpay for junk. Well, one of the things with junk silver that we've seen is the premiums have gone up tremendously over the past couple of years, and I think that that's a trend that's going to continue, though. I do think that the days of paying spot or close to spot for junk silver are over. They haven't made the stuff in over 6 decades now, or close to 6 decades. 1964, last year they minted that stuff. So that's a very long time ago. A lot of that has been melted down. A lot was melted down in 1980. I would reference the article After the Melts. I think that's by the PCGS. You can find that on their website from 2001. It's with a coin dealer who talks about how many bags of junk silver he melted down back in the 80s. Also, quite a bit was melted down in 2011. So yeah, I like junk silver. Premiums are a bit high on it, but I think they're just going to go higher. So if you're like a new stacker, you probably want to focus on getting, ounces of some cheaper stuff, lower premium stuff, like some silver bars or some silver rounds. But, if you see any kind of a dip in the premium on junk, probably take advantage of that. Not advice, of course, I'm just telling you what my thoughts on things are. But anyway, yeah, so today, I don't think that this silver sell-off really makes a lot of sense. I mean, and the reason that markets are going to be shocked when the truth comes out is because, I mean, moves like this, they really show you that investors believe, at least investors in the, paper silver and gold market, because that's what's driving this price action. I don't think too many stackers are running out there and saying, oh, the GDP went up, let me unload my physical metal. But, paper silver is getting sold off. And when folks realize that the Fed doesn't really have inflation under control, and they realize that the economy is not healthy, it's falling apart despite all of the propaganda to the contrary, then there's going to be a rush for the exits, and I think the dollar is being set up for a massive devaluation here. I think that we are being herded towards massive Fed intervention. What will the crisis be that they use to justify the intervention? Who knows? I mean, there's certainly plenty of black swan landmines out there that we could come across. Maybe it'll be that, war breaks out with China and they suddenly dump $1 trillion worth of treasuries. Fed has to intervene. What would they say? We'd say we have to do it. And they'll have all these excuses, all these reasons why it must be done. Um, just like in 2020, a virus breaks out, and all of a sudden, oh, there's a virus. We got to create $4 trillion out of nowhere. I mean, the logic behind this stuff is shockingly ridiculous, but the populace is going to get behind intervention because I'm sure that they'll get a bone thrown to them. There'll be some stimulus checks or some UBI or something associated with it. Probably a CBDC too. I mean, who knows what the next intervention will look like? It's not going to be pretty though, folks. And I do think that holding physical metal, when the time comes, you'll be glad you have it. That's all I really have to say about that. Today is just a buying opportunity. The fact that other folks are being irrational, be a strong hand. Don't go into this market and, use a bunch of leverage to buy metals. That I would not do that myself. I don't think that would be a good course of action. But getting your hand on hard assets, the kind that, can't be printed, you don't have to worry about the whim of the central bank. It's a no-brainer to me. It's a no-brainer to me. Someone in this chat that says if the ratio, I'm assuming you mean the gold to silver ratio, gets to 65 to 1, you'll consider converting some. 65 to 1 would still be kind of high for the gold to silver ratio, if you ask me. I would consider converting silver to gold maybe at like a 30 to 1 ratio. We got almost to that point in 2011, and I do think that this next rally in the precious metals, the next bull market is going to drive a lot harder than 2011. I mean, look at the difference between now and 2011. 2011, what was the US debt like? 10, 11 trillion dollars, something like that. Now it's 32. The Chinese were still buying treasuries back then. Um, I mean, inflation, the cumulative inflation, if you inflation adjust the highs, the metals are just going to be moving much higher this time. I think that we're going to hit like 30 to 1, 20 to 1, possibly. Could be 10 to 1. That's like, the natural ratio, right? In the Earth's crust of the mining ratio, I think it's something like 9 to 1. So, yeah, I think 65 to 1, I would still be stacking silver personally. But yeah, 30 to 1's not that crazy. I mean, just look at a chart of the gold to silver ratio and you see that back in 2011, it got close to 30. And that wasn't even a rally the likes of which we're going to see the next time around, in my opinion. I mean, I could be completely wrong. You don't know what you don't know, right? Not going all in on silver, but I'm probably allocated a lot more to the metals than your average individual. And, most folks out there, I think, don't even have a clue. That's why the metals are selling off on something like a positive GDP print. And the fact that the metals are still so unloved, it's like you want to buy assets when they're cheap, right? You don't want to wait until they skyrocket to go into the market and buy them up. And by any measure, $24 and change for an ounce of silver in 2023 today is just absolutely ridiculous. And these pullbacks, I think, are really just gifts for us stackers. So let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker out.